Hi, this is Mike Larson from Money and Markets TV. More than ever, I'm convinced that we're entering a new bear market and that a double-dip recession is next. In fact, I think the evidence is irrefutable. Just consider, the Dow has dropped 1,500 points in less than 3 months. The S&P 500 has fallen as much as 20%, the classic definition of a bear market. And the Russell 2000 index of small-cap stocks just tumbled to its lowest level in 13 months. Meanwhile, in Europe, the cost of obtaining dollars to pay off the dollar-based loans these banks have to pay back is surging to 3-year highs. And the cost of credit default swaps for insurance on bank bonds, as well as European sovereign debt, is at or near record highs. Moreover, the yields on junk bonds are soaring. These are all classic indicators of extreme stress in the credit markets. And despite the relatively positive September employment report, the economic data is looking just as bad. Sure, U.S. employers created 103,000 jobs last month, but the unemployment rate remains stuck at 9.1%. And the all-in unemployment rate, that includes discouraged workers who can't find work or can't find full-time work, surged to its highest level in 2011. Bottom line, the overall labor market is still extremely weak. And the forward-looking indicators look even worse. For example, Challenger Gray and Christmas tracked more than 115,000 corporate layoff announcements last month, the most since April of 2009. And according to the Conference Board, it's harder for consumers to find jobs now than at any point since 1983. And of course, the housing market shows no signs of bottoming either. So it's clear to me that the post-recession rally has fizzled out. But the question is why? And the answer is that we tried to paper over our problems with the same failed policies that got us into the mess in the first place. We tried to combat a debt crisis brought about by borrowing and spending even more money we didn't have. We tried to combat excessive leverage brought about by keeping interest rates too low and money too easy by pushing rates even lower and easing monetary policy even further. And we tried to deal with mega banks that have delved too deeply into complex financial instruments by bailing them out and merging them into even bigger mega institutions. And most importantly, policymakers from Washington to Frankfurt to Tokyo learned the wrong lesson from the 2008 meltdown. They decided we should have a policy of no more Lehmans, regardless of the cost. So now, rather than just having a bunch of troubled banks dragging us down, we have troubled banks in troubled sovereign nations. Greece is already on the verge of default, while Portugal and Ireland aren't far behind. Italy's debt rating was just slashed 3 notches by Moody's, while France's debt costs are soaring due to fear that its AAA rating is in jeopardy. Even Germany, at the core of the Eurozone, is taking heat as its potential bailout tab climbs sky high. This is why I continue to advise subscribers to my Safe Money Report about how to protect themselves. First, eliminate most of your stock exposure, taking advantage of bear market rallies like we've just seen to sell at higher prices. Second, eliminate exposure to real estate and riskier bonds. And third, add inverse ETFs as hedges and profit-generating vehicles on rallies until the big picture, fundamental, and technical outlook changes. I'm Mike Larson for Money and Markets TV. Thanks for watching.